Okay, take a deep breath. Seriously.
Yeah.
If you looked at a ticker tape today, Thursday, January 29, 2026, you probably thought the machine was broken.
Oh, absolutely.
We are seeing market moves that usually take a decade happen in, 6 hours? We're calling it Super Thursday, but
Chaos Thursday feels more accurate. It's definitely one for the history books.
it is.
I mean, we have trillions in market cap just flying around. Gold is hitting numbers that look like typos. And the political temperature in the U.S., well, it's boiling over.
It really feels like a pivotal moment. You've got the Magnificent Seven earnings basically rewriting the rules of the stock market.
Right.
The Fed is holding the line, and a government shutdown is looming over this incredibly tense situation in Minneapolis. So the mission for this deep dive is to connect those dots. We need to figure out why the market is punishing success, why gold is suddenly everyone's favorite asset.
And why CEOs are suddenly terrified to speak in public.
Exactly.
And we will get to the guy with a barbecue fork trying to break into a jail.
I still can't believe that's a real story.
It is. But the red thread today is divergence. The economy is splitting into two very different realities, and today, that split became a chasm.
Okay, so let's start with the money, the tech earnings. For the last 2 years, the playbook was simple. Say AI, spend a ton on chips, your stock goes up.
And today, that playbook got shredded.
Completely.
If you look at the board, it's a bloodbath for some and a huge party for others. The headline casualty is Microsoft. Shares plunged about 10%.
Which, for a company the size of Microsoft, is just astronomical. That's hundreds of billions of dollars.
$357 billion.
Just evaporated.
Gone in a day. Just to put that in perspective, that is larger than the entire market cap of most companies in the S&P 500. It's their worst trading day since, March 2020?
The pandemic panic. But here's what I don't get, and I think a lot of our listeners are scratching their heads on this one. Microsoft is the AI leader.
Supposedly, yes.
They own the partnership with OpenAI. They're embedding Copilot into everything. How do they drop 10%?
This is where the nuance is so critical. It wasn't that they lost money. It's about expectations versus reality, specifically in the cloud. Their Azure cloud growth slowed to 33%.
Now, in any other industry, 33% growth is a miracle.
A miracle. But Wall Street has priced Microsoft for absolute perfection.
And 33% isn't perfection.
Exactly. But the real kicker, the thing that really spooked the street, was the spending. Their capital expenditures, or CapEx, jumped 66% to $37.5 billion.
Wow.
So investors looked at that bill, looked at the slightly slower growth, and said, wait a minute, you're spending a fortune on AI infrastructure. Where's the explosive return?
It's the ROI question finally landing. It feels like for a long time, investors were just happy to see the spending because it meant innovation.
Right, spending was the signal.
Now they want to see the receipt. They want the cash.
They do. And Microsoft's CFO, Amy Hood, she gave a really interesting defense on the call. She essentially said, it's not a demand problem, it's a supply problem.
What does that mean?
She claimed they couldn't meet customer demand for AI because they didn't have enough data centers and GPUs online yet. She said they were actually prioritizing their internal use over paying customers.
That sounds a little like the dog ate my homework, though. We have so many customers, we just can't serve them. Do investors actually buy that?
Well, clearly not today. The market is saying, prove it. If you're prioritizing internal tools over paying customers, those internal tools better be generating massive revenue.
Right.
And right now, the visibility on that is foggy. Now, contrast that with Meta.
Okay.
Mark Zuckerberg is effectively doing the exact same thing, spending a fortune. They plan to spend between $115 and $135 billion on AI.
That's the size of a small country's GDP.
It is. But Meta stock is up over 10% today. Why?
Let me guess.
They can show the results.
Exactly. Their ad revenue is up 24%.
Yeah.
Zuckerberg could point to the scoreboard and say, the AI is making our ads smarter right now. We are making money today.
So tangible results versus a theoretical promise.
That's the difference. Microsoft is selling a promise of future software dominance. Meta is selling better ad targeting today.
And then you have Apple. I feel like for the last 6 months, the whole narrative was Apple is behind. They missed the AI boat.
And today, Apple proved that being late doesn't matter if you have the hardware. Revenue surged 16%. But the specific number that matters is China. Sales there bounced back 38%.
38%.
Yeah. Everyone thought Apple was dead in China because of Huawei and government bans. Tim Cook just proved them all wrong.
That China reversal is huge. But I want to pivot to something you flagged in the notes, what you called the software bear market. Because while the hardware and ad giants are fighting, something pretty scary is happening to regular software companies.
This is probably the most significant intellectual shift we saw today. Look at a company like ServiceNow. Great company, solid management. They make workflow software for big enterprises.
Right?
They beat their earnings expectations, they raised their guidance for the future, and the stock still plunged 10%.
That just defies the basic laws of finance. Beat and raise usually means the stock goes up, so why the sell-off?
Unless the market thinks your entire business model is terminally ill. Investors are starting to price in a future where AI replaces the need for seats and software.
So you mean if I use AI agents to do the work, I don't need to buy a Salesforce license for a human sales rep?
Precisely. It's the agentic AI thesis. If Anthropic's new Claude Opus 4.5 or OpenAI's next model can do the workflow, why am I paying ServiceNow for a license?
The narrative has shifted. It's not AI helps software companies, it's AI replaces the software.
Completely. And that is terrifying if you're a SaaS investor. It's a fundamental existential threat.
It really is. It forces them to completely rethink how they even charge for their products.
Right. If you aren't selling seats because the users are robots, you have to sell outcomes. That is a very hard pivot to make.
Speaking of existential threats, there's a very noisy rumor about Amazon today.
A $50 billion rumor.
$50 billion.
Yeah. Sources are saying Amazon is in talks to invest up to $50 billion into OpenAI.
That's bizarre. They already poured billions into Anthropic, which is OpenAI's biggest rival. Why play both sides?
It's the ultimate hedge.
Oh.
But more importantly, it's a power play against Microsoft. Microsoft essentially owns OpenAI right now.
They have the biggest stake, the deepest integration.
Right. So if Amazon throws $50 billion at Sam Altman, they dilute Microsoft's control. It suggests Amazon doesn't want to rely on just one horse in this race. They want to own the racetrack.
It feels like this giant arms race, and the money involved is just staggering.
It is. Plain and simple.
Okay, so tech is chaotic. Let's zoom out to the macro picture. The Federal Reserve met today. I assume, given all the chaos, they just held steady.
They did. Kept rates in that 3.5% to 3.75% range. The statement was pretty vanilla. Economy's solid, inflation is somewhat elevated, so we wait.
But the market reaction to waiting was fascinating. I'm looking at gold.
It went parabolic.
Parabolic is the word for it.
Gold surged past $5,200 an ounce. It briefly touched $5,500.
Gold is usually the boring asset. It just sits there. Why
Right.
is it moving like a crypto coin all of a sudden?
Fear. This isn't an inflation trade anymore. It's a safety trade. You have geopolitical tension everywhere. Greenland, Venezuela, the Middle East.
Right.
You have a U.S. government shutdown looming. And critically, the dollar is falling. It's near a 4-year low. When the dollar gets weak and the world gets scary, money runs to gold.
It's the bunker mentality. Get me something real.
It is. And it's not just individuals hoarding coins. The big funds are positioning. Did you see the numbers from the Norway Wealth Fund?
The oil fund, the biggest one in the world.
That's the one. They just posted a $247 billion profit for 2025.
That is a staggering amount of money.
And it was driven by the exact same tech and banking boom we were just talking about.
Yeah.
They are riding this wave. But what's interesting is that while the smart money is buying tech and gold, regular people are finally catching a break on their biggest budget item.
Rent. Finally. We've been talking about rent inflation for, 3 years? It felt like it was never going to end.
The fever has finally broken. Apartment rents dropped to their lowest level in 4 years, down 1.4% nationally.
And what about the pandemic boom towns?
Even sharper. Austin, Texas is down 6.3%.
Wow. Austin was the poster child for rents only go up. What happened?
It's just basic supply and demand. Developers spent the last 3 years building like crazy to chase those high rents. Now, all those buildings are opening just as the job market tightens up.
Yeah.
Landlords have lost their pricing power.
It's a good reminder that the cure for high prices is high prices. Eventually, you overbuild.
Exactly. Markets work. It just takes time.
While we're on the topic of regular people managing money, there was a practical tip in the stack about banking that I thought was interesting.
Oh, yeah.
With the Fed holding rates, everyone is obsessed with high-yield savings accounts. But the notes suggest that chasing the absolute highest rate might be a mistake right now.
It's about liquidity. So right now, you can get maybe 4.5% or 4.7% if you lock your money in a digital-only bank with no branches. But if you have an emergency,
Like your car breaks down.
exactly, you need a rent deposit, something immediate. Transferring that money can take 3 days.
Which feels like an eternity when you need cash on a Friday afternoon.
Right. So the sources highlight accounts like the UFB portfolio or Synchrony. They might offer slightly less yield, maybe a fraction of a percent lower, but they give you an ATM card or check writing.
So access.
The insight is, don't trade 0.2% of interest for the inability to access your own money. Cash is only king if you can actually spend it when you need it.
That is solid advice. Don't let the algorithm optimize you into a corner.
Precisely.
I want to shift gears to the corporate world, specifically the old guard, because while the software companies are panicking about AI, some of these legacy companies are making huge comebacks.
By doing something very simple, listening to their customers.
Let's talk about Southwest Airlines. This is huge.
It's the end of an era. After 54 years, Southwest is killing the open seating policy.
No more lining up in the A group and praying you don't get a middle seat. No more saving seats with a jacket.
No more cattle call. They are moving to assigned seats. And Wall Street absolutely loved it. The stock jumped to nearly 19%.
19%.
Biggest single-day gain for Southwest since 1978.
But why does Wall Street care so much about assigned seats?
It's about revenue, pure and simple. People will pay for certainty. It opens up a massive new revenue stream for premium seats, extra leg room, early boarding guarantees.
All the stuff they were leaving on the table.
Exactly. They forecast profits to quadruple in 2026 just because of this switch. It proves that sometimes tradition is just a fancy word for a bad business model.
Or at least an outdated one. They adapted, just like Starbucks is trying to do.
Right, with the new CEO, Brian Niccol, the guy they brought in from Chipotle to fix the coffee.
And his plan is called Back to Starbucks.
It kicks in March 10. He's bringing back the old loyalty tiers, green and gold status.
People were furious when they gutted that rewards program. It felt like they were punishing their best customers.
They were. The new strategy is smart. Incentivize the occasional customer. The person who comes in every day is already captured. They need the person who comes in twice a month to come in 3 times.
But I saw something about new espresso machines, too. Is that just marketing fluff?
No, it's manufacturing physics.
Yeah.
These new machines are significantly faster. Niccol's background is fast food, Chipotle, Taco Bell. He views coffee as a throughput problem.
Right.
If he can shave 15 seconds off every latte, he adds millions to the bottom line because the line moves faster.
So less coffee shop vibes, more caffeine factory.
If it reduces the wait time, customers will take it. And then you have GM. General Motors is up 70% in the last year.
Which is the quietest 70% rally I've ever seen. Everyone talks about Tesla, but GM is crushing it.
They're playing the political game perfectly. They're sitting on a massive pile of cash, $21.7 billion. They're ready for tariffs. They're ready for deregulation. They aren't betting the farm on EVs exclusively anymore.
They're selling what people want today.
Which brings us to the elephant in the room, politics. It's impossible to separate business from politics right now, especially with what's happening in Minneapolis.
It's a very delicate, very dangerous situation. Tensions are incredibly high following the shooting of an ICU nurse, Alex Pretty, and another citizen by federal immigration agents.
During Operation Metro Surge, the ICE crackdown.
Right. And usually in a crisis like this, especially in Minneapolis, which is a corporate hub, you'd expect CEOs from Target, United Health, Best Buy to release statements.
We stand with our community, that sort of thing.
But the silence is deafening.
It's what the sources are calling the silence or backlash dilemma. CEOs are terrified. They're very clear on this. Corporate leaders are citing Donald Trump's lawsuit against Jamie Dimon as a cautionary tale.
Can you explain that for listeners who might have missed it?
The perception is that if you speak out against the administration's policies, you invite retribution.
Regulatory headaches, tweets that tank your stock.
Or literal lawsuits. So you see companies like Target signing a group letter calling for de-escalation, but they didn't name names. They didn't point fingers. They're trying to walk a tightrope in a hurricane.
And this situation in Minneapolis is now threatening to shut down the federal government this weekend.
It is the sticking point. The funding deadline is Saturday at 12:01 ET. Senate Democrats are drawing a line in the sand. They want funding stripped from the Department of Homeland Security, specifically because of these shootings.
So they're willing to hold up the defense budget and everything else over DHS.
That's the brinkmanship. The plan right now is to try and split it past funding for the rest of the government and do a short-term stopgap for DHS so they can fight about it later.
Correct.
But it's going to go down to the wire.
While we're on government actions, there was a surprising headline about Venezuela. American Airlines is going back.
First time since 2019. This is a direct result of the geopolitical shift. Following the U.S. capture of Venezuela's president and the strikes that followed, the State Department essentially signaled the environment is stable enough to resume commercial travel.
That is a rapid normalization. That kind of thing usually takes decades.
It's fast. And speaking of rapid and bizarre legal situations, we have to talk about the fake agent in Brooklyn.
I read this 3 times to make sure it wasn't satire.
It reads like a Coen Brothers movie script. A guy named Mark Anderson shows up at a Brooklyn jail. He's dressed up, claims he's an FBI agent, and he presents a fake court order to release Luigi Mangione.
The guy accused of killing the United Healthcare CEO.
That's the one. Anderson thinks he can just walk him out. But when they arrest this guy, they search him. He's carrying a circular blade like a pizza cutter and a barbecue fork.
A barbecue fork. What was the plan? Was he going to tunnel out with a kitchen utensil?
It is completely unhinged, but it highlights the chaotic, almost surreal energy surrounding that entire United Healthcare case. It just attracts chaos.
It really does. Okay, let's try to land the plane with something a bit more forward-looking. Innovation versus safety. Right. We talked about AI, but the other big tech frontier is autonomous driving. Waymo is making moves.
They are. Waymo is officially offering service to SFO San Francisco International Airport. That is a massive vote of confidence. Reports are chaotic.
Handling that traffic loop requires some serious tech confidence, but there's always a but.
But at the exact same time, they're under a new NHTSA investigation. A driverless Waymo struck a child near a school in Santa Monica.
That is every parent's nightmare.
The child had minor injuries, thankfully. But it keeps that safety versus progress debate wide open. Can we trust these things in school zones? Kids are unpredictable.
It's always 2 steps forward, 1 regulatory investigation back. And finally, looking way up, the space economy is getting political too.
York Space Systems, they just IPO'd, opened at $38 a share. But the pitch wasn't just, we launched satellites. The CEO explicitly pitched their ability to build President Trump's Golden Dome.
The missile defense shield.
Right. He is positioning the company not just as a space company, but as a national defense necessity.
Which goes back to your earlier point. Everything is political now, even orbit.
Follow the government contracts, follow the growth.
So let's try to synthesize this whole chaotic day. We started with Microsoft crashing because of AI spending and ended with missile shields. What's the takeaway?
I think the theme is the reality check. Look at the software market. Investors are dumping SaaS stocks because they fear the future reality of AI.
Right.
But then look at Southwest, GM, and Meta. They are winning because they are delivering current reality-assigned seats, trucks that sell, and ads that click.
That's a fascinating distinction. The market is tired of hearing about the total addressable market in 2030. They want to know if you can sell a seat on a plane today.
It's a flight to tangibility. If you're selling a digital promise, you are being punished. If you're selling a physical reality, gold, oil, seats, cars, you're being rewarded.
And if you're a CEO, keep your head down, build your cash pile, and maybe don't tweet about the White House.
That is probably the best advice of the day.
We covered a lot, from the AI capital expenditure crisis to the gold bunker trade. It's a volatile time, but those are usually the times when the biggest opportunities appear.
If you can separate the signal from the noise.
Absolutely. That's it for this deep dive. Make sure you check your own stack of sources. We've linked the earnings reports and the analysis in the notes. We'll see you next time.